Hey everyone, welcome back to Mortgage Market Minute. I'm Chen, your mortgage broker at Simple Mortgage, and today is June 18, 2026. This week has a little bit of everything: a surprising surge in mortgage demand, an inflation number that caught a lot of people's attention, a major geopolitical development that's already moving markets, and what might be the most important Fed meeting of the year so far. Let's start with something that might surprise you. Even though mortgage rates ticked up slightly last week, mortgage demand actually surged. Total application volume rose 10.8% week over week, according to the Mortgage Bankers Association. Here's the rate detail. The average 30-year fixed rate for a conforming loan rose to 6.60%, up from 6.57%. Refinance applications jumped 15% for the week and are up 20% from a year ago. Purchase applications climbed 7% for the week and are 4% higher than this time last year. One more interesting data point: adjustable rate mortgages made up 8.6% of total applications, with the average 5-year adjustable rate mortgages coming in at 5.96%, noticeably lower than the 30-year fixed. Some buyers may be using adjustable rate mortgages to access lower initial payments or pushing purchases forward before the slower summer market sets in. Now let's talk about something bigger: inflation. The latest report showed the annual inflation rate jumped to 4.2% in May. That's the highest level since early 2023, and it's up half a point from April. What's driving it? Energy. Oil prices have risen 35% since the US and Israel attacked Iran back in late February, and energy costs accounted for more than 60% of the entire monthly price increase, according to the Bureau of Labor Statistics. There's also a wage story tied to this. Average hourly earnings are growing at 3.4%, which means for the second month running, inflation is now outpacing wage growth. And when you adjust for inflation, real weekly earnings actually fell 0.7% over the past year, the steepest decline since February of 2023. That's a real squeeze on household budgets. Now here's a major development that ties directly back to that inflation story. According to statements from President Trump and Pakistani Prime Minister Shehbaz Sharif, the United States and Iran have reportedly reached a ceasefire declaring an immediate and permanent end to military operations. A signing ceremony is reportedly being planned in Switzerland. One immediate effect: the reopening of the Strait of Hormuz, which has eased concerns about oil supply disruptions. As a result, WTI crude oil has fallen to approximately $80 a barrel, down nearly $5 from its recent highs. We're already seeing the ripple effects in the bond market. Mortgage bond prices are higher this morning, which pushes yields lower, and stock futures are pointing to a strong opening for equities. Why does this matter for your mortgage? If this ceasefire holds and implementation goes smoothly, it could continue putting downward pressure on oil prices, inflation expectations, Treasury yields, and ultimately mortgage rates. Given that energy was the biggest driver of May's inflation spike, easing oil prices could meaningfully change the inflation picture going forward. This brings us to maybe the biggest story of the week. It's Federal Reserve Week. The Fed's 2-day FOMC meeting begins Tuesday and wraps up Wednesday. The policy statement comes out at 2 p.m. Eastern on Wednesday. Markets will be watching closely for any clues about future rate cuts, and especially for how the Fed addresses that 4.2% inflation reading. This is a fascinating moment for the Fed to be meeting. They've got easing oil prices from the ceasefire pulling in one direction and a hot inflation print pulling in the other. How the Fed balances those two forces in the commentary could move mortgage rates noticeably in the days ahead. Let's also touch on a couple of technical levels that bond traders watch closely. The Fannie Mae 30-year 5.5% coupon, a benchmark mortgage bond, remains above a key support level at par. That's a good sign for mortgage rate stability. Meanwhile, the 10-year Treasury Yield, which closely tracks where mortgage rates go, is sitting near 4.45%, with the next support level at 4.40%. If yields break below that 4.40% mark, it could open the door for rates to ease further. Let's recap what we covered today. Mortgage demand surged 10.8% even as rates ticked up slightly, with refinances and purchases both climbing. Inflation jumped to 4.2%, its highest level since early 2023, driven largely by energy costs tied to the Iran conflict. A reported ceasefire between the US and Iran has eased oil prices significantly, which could help cool that inflation picture going forward. And then, It's a pivotal week for the Federal Reserve, with their policy decision and press conference both landing Wednesday against a backdrop of supportive technical levels in the bond market. If you want to understand what all of this means for your specific situation, whether you're buying, refinancing, or just trying to plan ahead, let's talk. I'm Chen at Simple Mortgage here in Southern California. Call or email me. You can also find us on Facebook, Instagram, and YouTube at Mortgage is Simple. Thanks for watching Mortgage Market Minute. I'll see you next week. And remember, this content is educational only, not a commitment to lend. Rates and programs subject to change. For personalized guidance, reach out directly.